everybody. We are going to conclude this very long day on Mining Stock Daily with the last corporate update. Integra Resources published PEAs, a PEA, and a mineral resource estimate for both Wildcat and Mountain View projects in Nevada. These were projects brought into the company through that merger with Millennial Precious Metals. Jason Kosec's here with us, the CEO of Integra, previous CEO of Millennial Precious Metals, so he knows these projects like the back of his hand. Jason, you gotta love to see these numbers. Honestly, I've been watching these numbers. I've been watching these projects for. I think you and I have been working together for a couple of years, and these numbers came in better than I expected. I'll just say that. And I think they came in better than maybe you expected. Is that safe to say?
Yeah, it goes back to the days when I was a mine geo, and we'd always sandbag, the grade at least by 10%. So we'd always underpromise and overdeliver, and makes our life always a lot easier. So it was purposely sandbagged to the market so we can kind of outperform when we release things.
Yeah. So general economic numbers for both projects, and these are going, working together, combining after tax NPV of just under $310 million with an IRR of 36.9%. Obviously pretty good. This is a PEA, so it's a snapshot in time of what a project would look like now. Obviously a lot of work to do. Initial CapEx costs $115 million to begin operations at Wildcat. And I think the number that really spoke loudly to me is that cash cost per ounce of under $900. Not too many projects can have that low of a cash cost per ounce of gold. It takes a special type of project, oxide, low strip ratio, good enough gold grade to get that up there. So, give us a sense. I guess those are the numbers. Before we kind of break this down, Jason, would love to know the thought process of you and the company deciding to combine both these projects into a single technical report like this.
Yeah, so what we wanted to do is have a project that has the scalability that can be, covering around 100,000 ounces a year producer, and sharing infrastructure and sharing shovels and trucks and sharing people because of their proximity to keep that CapEx number as low as humanly possible. Okay. That was really the synergies of why we presented it like this. There will be a significant amount of overlap when both are in production, and it goes on how you're phasing into the mine. So you'll move the bigger trucks, bigger shovels over to Mountain View when you get lower in the pit at Wildcat, and then bring the smaller trucks and shovels over at Mountain View when you get lower into the pit there. So just really optimizing the sequencing at both projects, and the proximity allowed us to do that.
I guess why start at one? Why start at Wildcat as opposed to starting at Mountain View? Is there a reason for this?
Yeah. So one reason, and primarily the main reason, is the permitting scenario. The thing with Wildcat, because it does not touch the pit lake and there's no waste rock, we believe we can permit it under an EA and not an EIS. As soon as you intersect the water table and you have big waste rock facilities, it pushes you into the EIS process, with tax on another year and a half. So from a permitting perspective, that's one thing. Then at Mountain View, you're going to have about 2.5 years of stripping in the alluviums. And now, 70% of the waste rock is alluviums, and it's a free dig scenario. Okay. So you're saving about 30 cents, 40 cents a ton from your mining costs, because you're just basically taking a shovel and removing it. Whereas at Wildcat, it's right at surface, you're right into the ore, and you could start processing, within a year. So, given the deposit types, that is really why.
Okay. Combined annual production of 94,000 ounces gold equivalent for the first 5 years of life, annual production 80,000 ounces over a 13-year mine life. And this is really interesting, Jason. I think as a shareholder of this company, when I saw the PEA, before I actually read the numbers, my gut instinct was, why so soon? Because I know there's a lot of exploration potential out there on both projects. You need to get those permits ready to go, but all your time as Strictly with Millennial Precious Metals, you had talked to me about continuing to de-risk both projects with the very small area of disturbance you were allowed to work on. You're looking to expand that area, and so we know the project's very much de-risked from an exploration standpoint. It's just a matter of getting drills into those other areas. And so there are probably potentially a lot more ounces of gold to be found at both projects. And so explain to me, as a shareholder and other people listening, why put out a PEA this early in the process when you know that there's a lot of exploration potential here on both projects down the road?
Yeah, Trevor, one thing we've always talked about, right, is that as much as we're in the business of adding ounces in a systematic, scientific manner, we are also in the business of risk mitigation. And frankly, most junior companies forget that. And we wanted to be extremely transparent and really show a base case scenario of what the potential production will be. Just scraping the surface. As you mentioned, these were drilled on 5 acres of 27,000 acres. Okay. And what we wanted to remove and be transparent to the market is we did over 24 columns, over 184 bottle rolls, a lot of infill drilling, a lot of geotech drilling to show how robust these economics are. And we got to remember that of the 1.75 million ounces of the resource, 80% of that is indicated. So commonly, most PEAs, 20 to 50% are indicated, 80% is indicated. Okay. So what we wanted to show the market that is, here's the base case. Here's the technical work that's gone forward to de-risk this project. And as we step out through the exploration process, people can simply just go into their model, update their DCF, and add those tons as we step out and grow the resource base. You got to remember too, is that, the resource that we did, we took it from 1.2 million ounces to 1.75 million ounces under a 5-acre permit and converted 80% into indicated. The team has done a fantastic job. But in the PEA, we're only using 1.47 million ounces. So what we did is the resource is using a $1,700 pit shell. The PEA is using a $1,200 pit shell. And basically, where the whittle optimization works is where the curve starts to flatten, and it's kind of the sweet spot to maximize the NPV. But those ounces are real and they're in there. So, we strongly believe, my promoter side wants to say we could double the resource. I'm not going to put that much stress on our VP of exploration and our team, but, we strongly believe in being very conservative. You can grow the resource 30 to 50%. And you got to remember, every 10% you grow that resource adds an extra year or can increase the production profile to steady state, because we have a drop off in year 7 and 8 to maintain that steady state of 90,000. That 30%, 50% growth will infill that. And every 10% growth is an additional $50 million in after-tax free cash flow. Okay. Mm-hmm. So, we're just starting off here. And why we wanted to do this is to be extremely transparent, show the market that this thing is real, and then we could systematically grow it, and everyone can update their models as we go.
So what's next for these projects? This is a huge first step, but it's a snapshot in time. And what is next for Wildcat and Mountain View?
Yeah, so we are expecting to have the exploration plan of operations in Q4. It was submitted in the government the fourth quarter of 22. Okay. Mm-hmm. It's with the BLM. It's kind of somewhat out of our control, but we've been promised that it's the next permit they will issue. So as soon as that is in hand, we'll start the bigger exploration program and start stepping out. And for your audience out there, we're going from 5 acres at Wildcat to 400 acres. Okay.
Yeah.
So there's a lot of drilling and a lot of growth to be had, over the next 18 to 24 months.
Yeah.
So that's
what's interesting. Let's talk about the economics of this project outside of the numbers. And I think this is where mining projects can really shine, and that's how many jobs you're going to create, Jason. I mean, again, early stage, but in this PEA, you talked about, it seemed like, I think, 200 types of jobs just for these Nevada projects alone. You talked about being an owner-operated mining project, so you will mine it. You won't. It sounds like you won't be doing some contract working for the mining. So this is really important. What does this mean for the area that these projects are located in, as far as economic development, and what kind of conversations are you having with local communities?
Yeah, we believe in engaging early and often, and building those relationships, because quite frankly, they take a lot of time. And when I was younger, I didn't believe in that. I thoroughly believe in that now, and it's paying off on the relationships that our team and myself have built in the local communities with our stakeholders. And adding jobs into kind of rural communities, it's not like it's in Winnemucca. It's in Lovelock and in Gerlach. Creating that many jobs is very helpful for those local communities, right? And these are high paying jobs as well. So indirect jobs, there's going to be, that's direct 200, but indirect, there's going to be substantially more people.
Okay. I do want to take a quick moment and step away from Nevada and ask you more about DeLamar. But what am I not asking about this PEA before we kind of move on here? I mean, what's something that you really want to hit home?
Yeah, I honestly think that the big thing is that every 10% you grow this resource, you're going to have an additional $50 million in after-tax free cash flow. And, you can see by the footprint, what we did is we wanted to understand the controls of mineralization. How big is the footprint? And right now we know from mapping and sampling, just in the immediate area, the resource that you see now is 1.5 by 1.5. We know the footprint from surface sampling and historical drilling is 3 by 2. So we know that is where it's going. And the other thing too is that, it's beautiful because we have an economies of scale here. There's not many projects that are going to be pushing 30,000 ton per day. And that's really why we have such, our tons treated is around just over $8. So that's why, our cash cost is such a good margin on that.
Yeah. You talked about the mineral resources at Wildcat and Mountain View. You increased the Wildcat by 23%, Mountain View by 49%.
So you broke up there, Trevor.
Let's talk about DeLamar, because we haven't had Integra onto the show for a little bit. And you continue to publish new results out of the stockpile drilling at DeLamar. So we're seeing growth.
You're breaking up
there as well. What is the latest of potentially new mineral resource update out of DeLamar?
So that should be coming out in early September.
This fall.
Yeah, you're looking at about an additional 50 to 60 million tons. Okay, you got to remember that the PFS used 81 million tons that generated about 314 million in NPV after taxes 1,700. So it'll have a significant impact on the economics. And not only that, that's going to push our global resource endowment just over 7 million ounces, of which, close to just over 4.5 are going to be leachable, making us the largest, open pit heap leach project that's not owned by a major mining company in the Great Basin.
And it now has economics.
That has economics. And, on a combined basis, this is going to be pushing just over 215,000 ounces per annum for an all-in sustaining cost of just around $900.
Yeah. The stock was up 12%. Probably the best day Integra's had in quite some time. Probably the best moving junior gold equity on the board today. I would say, from what I'm seeing on the screen. So it's nice to see some life, at least from one equity in this sector right now. Jason, thanks so much for your time, and we'll be talking again soon.
Thanks a lot, Trevor, and thanks everyone for listening in today.
All right. That's your update from Integra Resources. They put out a PEA for their 2 Nevada projects, worth a read. They trade on the Venture Exchange with ITR and on the NYSE American with ITRG.